You would be surprised at how many people come to JWB and they say, hey, I want to build up an income stream of $10,000 a year and I want to do it in 3 years. And I have $40,000 to put into it and probably 25 the next few years, right? That it's really important for us to guide that person and say, let me show you what this really looks like here in order to accomplish that. And many times people are surprised. It takes a lot longer, right? And we want to have those conversations up front. So Pablo, if you wouldn't mind, go all the way to the right there, because we're going to see a couple of things.
This way to the right or the other way to the right?
Well, that's actually even better. So lines 22 and 23, what we're doing there is we're tracking your total annual positive cash flow and your total annual equity gain from home price appreciation, right? We're seeing all 5 profit centers actually here. Your positive cash flow, we're including your tax savings and your principal pay down. Just trying to keep it simple here. But you see from your first year there, you're able to build up positive cash flow of about $6,300. In year 2, guess what? You keep that $6,300 and you added an additional property, which brings you up to $8,100 a year. And it's cumulative going forward down the line. And when it gets to annual equity gain, the number starts to get really large. Remember here, we talk about numbers about how Jacksonville's home price appreciation rate year over year on average is 4.3%. And we talk about how that's 19% more than the national average. We talk about other comparable cash flow markets are in the 3s and the 2s. And the reaction that I get from people when I tell them that is they're like, yeah, it's the difference between 2 and 4, Greg. Cool. And I'm like, I don't think you get it, because we're not talking about like $10 assets here. We're talking about you holding on to an asset that might be a $200,000 asset that's appreciating at 4% a year versus 2% a year is huge. And you holding on to this asset for 10 years or 20 years. I mean, these numbers get really significant. So again, if you go to that $23,000, $24,000 number that you're showing there, that's just the equity gain of owning 3 assets that went up 4.3% per year, right? Like it's $24,000. Again, what this should reiterate to everybody is like, if you're only looking at cash flow, you're missing the boat. When you hold on to assets for a full market cycle, the biggest determination of your return on investment is not going to be positive cash flow. It will be home price appreciation. You just got to give it long enough. You got to be invested for a full market cycle. So hopefully that sheds a little bit of light on that.
Yeah. And again, you're talking about a full market cycle. The historical rate is 4.3%. If we are really looking at this right now, year 1, based on what the market is doing year 1, you're really looking at much closer to that 10% or plus appreciation of what's happening in Jacksonville right now. You guys have just kind of normalized this throughout, like what to expect historical appreciation rate, right?
And I think that's the right approach, meaning looking at that 4% number, putting it here, because again, I can't play both sides of the fence. The fact that we've had more than 4% appreciation in Jacksonville last year is real. But again, I'm telling you that when you hold on for 10 to 20 years, it's not going to be over time. Most likely it's going to be right around 4%. This is a really big up. You're going to have years where it's lower than 4%. Probably not going to have a big dip like we had in the Great Recession, but it's going to be about 4% when you get through to the end of the full market cycle. And so I wouldn't even factor that in, that it's been, 11% appreciation year over year.
Okay. All right. So
sorry,
is it time to ideate now? Like, can we,
yeah,
I think
go to the other right, because what I want you to do is to take a mental picture of something here. And actually we'll probably be able to show it on the screen here, but look at the totals here over 10 years by taking this $350,000, right? That's the total capital that you invested, right? You controlled, call it $1.4 million of assets. The reason I'm getting to that number is roughly $200,000 times 7. You put $350,000 of your capital into it. You controlled and owned $1.4 million of assets that are kicking off after a 10-year period. They've kicked off over $100,000, $105,000 here in positive monthly cash flow. And over 10 years, you've earned over $500,000, actually $566,000 in equity gain from investing in a growth market. Really cool.
That's huge. That's really, really significant.
I mean,
I can't imagine I guess so what's the total investment? It's 50,000 per property. So what you said is $350,000 in 10 years to return, 200%. That's pretty significant thing that I wouldn't expect in the stock market. I wouldn't expect, like maybe a really, really good investment in a company that pays you a 2x, 3x multiple or something like that in 10 years. You could get something like that, but like getting 200% in 10 years is really significant.
Absolutely. And you probably can't do it with getting positive cash flow every single month, like we're talking about, right? And you probably can't do it in an asset class that historically goes up in value every single real estate market cycle. It has gone up in value. Sure, there's been years where we went down. We all know what that feels like. But even over the 20 years when you had the Great Recession, that 20-year segment, it still went up 4.3%, right? So you don't, and that's when I talk about risk adjusted return on investment. You can't get this kind of return, call it a 200% return over 10 years in a risk adjusted fashion, where you've got all of these things that mitigate your risk. One of the reasons why I love this asset class.
Man, makes a lot of sense. I love this. So this has been super powerful visualization.